Welcome to Finademy course of income tax and how to lower it. Our topic today is tax loss harvesting. Use the link in the description to download the app on the App Store for more courses and free practice tests. Number 1. Tax loss harvesting is a strategy that can help investors minimize any taxes they may owe on capital gains or their regular income. It can also improve overall investment returns. As a strategy, tax loss harvesting involves selling an investment that has lost value, replacing it with a reasonably similar investment, and then using the investment sold at a loss to offset any realized gains. Tax loss harvesting only applies to taxable investment accounts. Retirement accounts such as IRAs and 401k accounts grow tax deferred, so are not subject to capital gains taxes. Answer the question. What can tax loss harvesting apply to? A. Taxable investment accounts. B. IRAs. C. 401k accounts. D. All of these. The correct answer is A. Taxable investment accounts. Number 2. Tax loss harvesting is also known as tax loss selling. Usually, this strategy is implemented near the end of the calendar year, but may happen at any time in a tax year. With tax loss harvesting, an investment that has an unrealized loss is sold, allowing a credit against any realized gains that occurred in the portfolio. The asset sold is then replaced with a similar asset to maintain the portfolio's asset allocation and expected risk and return levels. For many investors, tax loss harvesting is the most critical tool for reducing taxes. Although tax loss harvesting cannot restore an investor to their previous position, it can lessen the severity of the loss. For example, a loss in the value of security A could be sold to offset the increase in the price of security B, thus eliminating the capital gains tax liability of security B. Answer the question. Which of the following is not true about tax loss harvesting? A. Tax loss harvesting is also known as tax loss selling. B. Tax loss harvesting cannot restore an investor to their previous position. C. Tax loss harvesting can lessen the severity of the loss. D. Tax loss harvesting is always implemented at the end of the calendar year. The correct answer is D. Tax loss harvesting is always implemented at the end of the calendar year. Number 3. There are certain limitations to the effectiveness of this strategy, in addition to regulations put in place by the Internal Revenue Service (IRS) about wash sale rule. Investors cannot deduct a capital loss on the sale of a security against a capital gain of the same security. This is called a wash sale. Wash sale rules prevent taxpayers from selling or trading a security at a loss and, within 30 days before or after this sale, buying the same stock or security, or a substantially identical one, or acquiring a contract or an option to do so. In the event of a wash sale, your tax write-off may be disallowed by the IRS. For investors that want to harvest their losses while also avoiding any wash rule violations, one strategy for an individual stock that loses value is to replace it with a mutual fund or ETF that targets the same industry. This will allow you to maintain a similar asset allocation in your portfolio. Answer the question. What is a wash sale? A. A sale of an asset or stock that the seller does not own. B. A sale of a security at a loss and repurchase of the same or substantially identical security shortly before or after. C. A sale of a security at a loss. D. A sale of a security at a loss and replacement of that security with a mutual fund or ETF that targets the same industry. The correct answer is B. A sale of a security at a loss and repurchase of the same or substantially identical security shortly before or after. To learn the full course, please download our free app Finademy on the App Store. Thanks for watching. Don't forget to like, share and subscribe to our channel for updated videos every week.